Welcome to Chapter 1 in Survey of Accounting. We're going to talk about the basics of accounting and of businesses and an overview of the accounting portion of businesses in this chapter. In later chapters, we'll talk about details of those things. In this chapter, we're going to learn about the different entity types. I'm sure you're familiar with them, but we will talk a little more in depth. We're going to talk about different pieces of the business, whether it's operating, doing what we're in business for, financing, or investing. We're going to talk about what accounting really is and how we use accounting and bookkeeping procedures to form our financial statements, and what are financial statements anyway. And then we're going to talk about accounting concepts, the rules, the reasons we do the things we do. And then we'll begin learning about analysis, because that's the point of all of this, so that we can analyze and understand our business. Very broad types of businesses are service, merchandising, and manufacturing. A service business, think your local hair salon, your local accounting service. Think bigger companies like Delta or Walt Disney. They do not sell product, they sell their services. A merchandising business obviously sells products. Think your local hardware store. Think Walmart. Think Amazon. Think drugstores. Think the grocery store. Those are merchandising businesses. They buy product and in turn resell it to the end user. A manufacturing business takes raw material or pieces of a product and either creates or builds a product from those items. Think Armco, or AK Steel, or a car manufacturer, or the company that made the computer that you're working on right now. Every business, hopefully before they start business, will determine what is called their entity type. Their entity type is the form of business that they take legally and for IRS purposes. Depending on your needs, you will determine, along with your attorney and accountant, what business type is best for your business. A sole proprietor is the most common form of business in the United States. Probably better than 70% of businesses are, or at least began as, sole proprietors. A proprietorship is owned by, you guessed it, one person. Some of the downsides of a proprietorship is that there is no separation between the owner and the business. A partnership is very similar to a sole proprietorship, except that it has more than one owner, hence the term partnership. A partnership, like a sole proprietorship, has liability problems inherent with its entity type. The partners have full liability for all the transactions of the partnership. And then there's the corporation. A corporation is a separate legal entity owned by the stockholders. There is a distinct separation between a corporation and its owners. A corporation is considered a legal entity because it can sue and be sued. It pays its own taxes. It can last forever, whereas proprietorships and partnerships have a distinct time frame based on the life or the participation of its owners. And then there is a relatively new company type, limited liability company. The great thing about an LLC is that it can be whatever you need it to be, and it can change as the business grows or contracts. It's a wonderful form of business that is being used more and more now that there is case law behind that entity type to prove that it can, in fact, limit the liability of its owners. In forming a business, there are some things that need to be taken in consideration for each business type. A proprietorship is very, very simple to form. In many cases, it's as simple as placing an open for business sign on your door, and you're in business. The legal liability, as I stated before, is great because there is no separation between the owner and the business. All of the owner's assets are subject to any lawsuit, any liability issues happening within the business because of that there is no separation. Taxation gets a little complicated for a sole proprietor. It is considered a pass-through entity because the business does not file its own tax return. Rather, the operations of the business are reported on the owner's personal tax return. I won't go into a discussion of the taxation issues. That's a little beyond the scope of this class. There is a limit on the life. The sole proprietor ends when either the owner passes away or retires from the business. Now, many times we will see the business change hands, continue operating, and from a public point of view, there has been no change. The business has continued. But from an accounting and legal standpoint, the business as it was closed and then reopened under new owners. Access to capital under a partnership or loans is a little bit difficult. Banks often view proprietorships as small, not having a lot of credit worthiness. The owners often have to put up their own assets as collateral for any types of loans. A partnership, as I said, is very similar to a proprietorship, except there's more than one owner. That is a plus in that you get different abilities from each owner, so you have more to draw on. But partners can also be a problem if two of the partners suddenly don't get along any longer. The other areas, they're simple to form, there's no limitation on liability, they're pass-through entities, and there's a limited life, are just the same as in the case of a proprietorship. They may have a little more access to capital because there is more than one owner. A corporation, it's a little more difficult to form. There's a whole lot of, let's call it, red tape involved with running a corporation. You need a board of directors. You have to keep minutes of your meeting. There are things that a corporation has to do that is not required in a partnership or proprietorship. A corporation has limited liability. Only the assets of the corporation are available in any liability issues, not the assets of the owners. Perhaps some of you own stock. If you do, you are owners of a corporation. And you don't worry that if the corporation gets sued, they're going to come after you because of that separation between the company and the owners. It is its own taxable entity. There is no limitation on the life of the entity, and their access to capital is pretty extensive in a couple of ways. They can sell more stock, which provides capital, and often a corporation has more availability to loans than other forms of business because they are perceived to be a big business. Even though I know of a number of corporations that are nothing more than a single person who owns all the stock, who operates from a desk in his basement. Go figure. An LLC, it's not that difficult to form. It has legal liability, and its taxation is determined by the elections that it takes at the time of formation. There can be a limitation on the life, and the access to capital really depends on the company itself. How does a business make money? They sell things, and they hopefully sell things for more than those things cost. They want to make a profit. That means that the expenses of the business, rent, insurance, payroll, taxes, utilities, all those things are less in cost than the revenue they make from selling either their service or product. Companies have a lot more than two strategies, but two are mentioned here. A low-cost strategy, think Walmart. They try to produce or buy product at the lowest possible cost in order to be able to resell that product at a low cost to the general public. Premium price strategy, think Mercedes-Benz, think BMW. They want to design and produce products that serve unique markets or unique needs, and they want to have a perception that this product is worth the price. We all believe that a Mercedes is worth the $60, $70, $80 or more $1,000 that you pay for one. I mean, it's a car with 4 wheels and a steering wheel. But the quality of the product, the perception of the public allows Mercedes to sell their cars at a much higher price. When you're thinking about those types of businesses, Southwest Airlines, Hyundai. It's a good car, but it is sold at a lower price. Sam's Club, Walmart, all those sorts of things. Super 8 motels. When you're thinking premium, on an airline, Virgin Atlantic, BMW, Ritz-Carlton. You can think of companies that fit both of those strategies. And there's many strategies in between those two extremes. Every business has stakeholders. What are stakeholders? Stakeholders is anybody or any business or any municipality that may have an interest in the company. Doesn't mean they're employed by or even a vendor of. It means that there is something that the company does that impacts them in some way. Capital market stakeholders. That's the stockholders of a corporation. And stockholders can be individuals, they can be investment companies, they can be retirement plans. All kinds of people and entities own stock. The customers or clients or patients of a business are stockholders or stakeholders, excuse me. They buy the service or buy the product of the company. Therefore, they have an interest in that company. The people, vendors, that sell their products to that company to be sold are also stakeholders. The government is a stakeholder, whether we're talking federal, state, county, local, whatever level of government are stakeholders because they collect taxes from the company. They also collect taxes from the employees of the company. Think about the local service tax that is deducted from your paycheck, or the earned income tax that is deducted from your paycheck. Internally, you have stakeholders such as the employees of the company, the management of the company, who of course are also employees. They have a very big interest in the company being successful. Also think about the municipalities, the place where the company is located. Not only does the company pay taxes, but often that company will provide social programs for the municipality. They employ the citizens of the municipality. They have an impact beyond just paying taxes in the area in which they're located. Here's just a further example of the stakeholders of a company. Stakeholders are different than stockholders. Stockholders are owners. Stakeholders are people who have an interest in the company for various reasons. All businesses participate in three basic business activities: financing activities, operating activities, and investing activities. Investing activities are those activities in which a business buys and sells its major assets. Assets are things that a business owns. And when we're talking about investing activities, we're talking about long-term assets. Think equipment, plants, buildings, vehicles, assets that will last the company for a long period of time. We also consider in investing activities things such as intangible, meaning I cannot touch them, assets, patents, goodwill, those types of things, franchise licenses. All of those are considered investing activities. Operating activities come from what the business is in business to do. The revenue or income that it receives from selling either its services or products, and the expenses that are involved in generating that revenue. Financing activities involve two areas. Equity financing, meaning we sell stock to finance our business, or debt financing, which means we borrow money in several forms from a bank, from other lenders, or sell bonds. We'll look more in depth at all of these items as we go further in our book. What is accounting? It's an interesting question. A business needs to take all of its transactions and put them in a format that will tell the story of the business, that will tell us if we're making a profit or not, that will tell us how many assets we own, that will tell us how much we owe to our lenders or owe for other things. So accounting is the procedures we use to gather that information, record that information, and report that information. As you'll see on your screen, it's called the language of business. Language is used to tell a story, and that's what we want to do, is tell a story. If we just provided a list of all the transactions of the business, it wouldn't tell the story. It would just be a lot of numbers. So we put them together in a way so that the story makes sense. Two major objectives are to report the financial condition of a business at a particular point in time and to report changes in the financial condition of a business over a period of time. This is an example of that. Reporting the financial condition as of a report in time, as of a point in time, is a snapshot. Reporting the financial condition of the business over a period of time describes the operations and performance of the business. Once all of the transactions are gathered and recorded in a manner that allows us to tell the story, we will prepare financial statements. We're going to look at financial statements before we ever learn about how to record those entries so that we know what our end product should be. The first financial statement that is prepared is the income statement. The second financial statement is the statement of retained earnings. The balance sheet is then prepared, and the last financial statement is the statement of cash flows. Each of those statements tell a different part of the story. The income statement, an example which is on your screen at this point, describes the operation of a company for a period of time. That period of time could be 1 month, 1 year, 1 quarter, but it's for a specific period of time. In that financial statement, the income statement, also known as the profit and loss statement, we show the total revenues, the total sales, the total income. Those terms are interchangeable for that period of time. We also show the total expenses for that same period of time. That determines if we've made a profit, net income, or a loss, net loss. We'll learn more about the matching concept as we go along, but we want to match the expenses and the revenue to the time period in which they are earned or incurred. The statement of retained earnings shows how the equity in the company changes. Now I want you to note the first line, retained earnings. That's from the period before. Add net income. Well, let's look at something. We're going to go back up for a minute. Do you see here on the income statement where we have net income? That amount is brought to the statement of retained earnings. So there's a relationship there. We then subtract dividends, determine whether we have an increase or decrease in retained earnings, add or subtract that to the beginning retained earnings to get our retained earnings at the end of this period. Retained earnings are the profits kept in the company. Dividends are the portion of profits that are paid back to the stockholders. We then prepare the balance sheet. The balance sheet is a listing of the assets or things the company owns, the liabilities, things a company owes, and the equity of a company. It is called the balance sheet because if you will notice, total assets equal the total, combined total of liabilities and equity. One other thing I want you to note is in the equity section, second line down, you will see retained earnings. Does that number look familiar? That's right. That number came from the statement we prepared just before the balance sheet, the statement of retained earnings. This report shows the financial condition of a company at a particular point in time. You will see on the screen at the bottom, assets equals liabilities plus stockholders' equity. That is the accounting equation. You'll need to remember that as we move forward. The last statement that we'll prepare is statement of cash flows. What we have looked at to this point is changes in the financial condition of the company as a result of operations. We looked at the income statement to determine profit or loss. Profit or loss is not the same thing as cash. Two different concepts, but both concepts are very important to a business and to the success of a business. So the last statement we look at is a statement that shows us the changes in our cash balance or our bank balance. The statement of cash flows lists the changes in cash flows from operating activities, what we're in business to do, our revenue and expenses, changes in cash flow from investing activities, and remember that's purchases of long-term asset or sales of long-term assets, and cash flows from financing activities. If we've borrowed additional money, if we've paid out dividends, if we've bought stock back from the stock owners, or if we've sold additional stock. It is important to know where your cash is coming from, inflows, or going to, outflows. I've seen many companies that are profitable but have not managed their cash correctly go bankrupt and end up out of business. Reported first on the statement of cash flows, as we saw, are the operating activities. That's the lifeblood of the company. If your operations fail, there is no company. This is most important to stockholders and stakeholders. Often you can see, or at least get a good idea, where the company is going from its cash flows in its operating area. Investing activities, as we looked at before, it's the second activity reported. And we know that this involves the purchase and sale of our long-term assets. It is normal for this section to be a negative. The equipment we buy is going to be more expensive than the equipment we sell, if there is any value at all in the equipment once it becomes obsolete. Lastly, we report our financing activities. As I stated, this section involves inflows from seeking loans or outflows from paying our loans, buying or selling of stock, our own company stock, not stocks we buy for investments, as well as dividends in this section. The financial statements are all related. You can see from this how they're related. The income statement moves directly to the statement of retained earnings. The ending retained earnings moves into the balance sheet. The cash, the amount we have in the bank and on hand, is detailed in our statement of cash flows. So all of the financial statements are related. Now we're going to learn some of the underlying concepts used in accounting. The rules of accounting are called the generally accepted accounting principles. We call them GAAP. That's a little easier to say. Those are formed by the Financial Accounting Standards Board, or better known as FASB. They develop those principles that we use. The accounting principles or accounting concepts, some of them, are the business entity concept, the cost concept, the going concern concept, the matching concept, objectivity concept, unit of measure concept, adequate disclosure concept, and accounting period concept. Business entity. The business entity concept says that we will record and use in our financial statements only the transactions that involve the business. Even though in companies like sole proprietors and partnerships, there is no separation legally between the business and the owner, when preparing financial statements, there is a separation. Only the transactions involving the business are recorded. Cost concepts says that we will use the purchase price for anything that we buy for the business. Example, I bought a car for my dad for my business. I paid him $5,000 for it, but the car's fair market value was actually $10,000. I do not record $10,000 into my books. I record $5,000. We don't use appraised or fair market value. We use the actual cost. Going concern says the company is in business and will continue to be in business for the foreseeable future, unlike a yard sale or a garage sale. A true business is considered to be in business for an indefinite amount of time. The matching concept or matching principle, and this is one that we'll talk about in much more depth as we move forward. But this principle requires that we record revenue when earned and expenses when incurred. And we'll talk about how that is done. Objectivity concept. Say that 3 times quickly. We must base our transactions on objective evidence or verifiable evidence. I wrote a check to buy the car. There's my objectivity, or the way I can verify the amount. But we are supposed to be objective in all of our accounting transactions. Unit of measure. This principle says that all transactions are recorded in the currency of the country in which we're in. Simply meaning, we record our transactions in dollars and cents, not euros or pesos or whatever other monetary forms there may be out there. Adequate disclosure. This says that we must include footnotes or other disclosures to describe or further detail transactions that may not be clear, so that stakeholders and stockholders can understand the financial statements. Accounting period concept. This says that we use periods of time. Generally speaking, the accounting cycle is for 1 year, although we will break that up into smaller pieces monthly so that we can see what is happening throughout the year. The accounting life is a 12-month period. That way we can compare excuse me, the financial history of a company. We can compare sales and revenues from 1 year to the other. We compare balances in asset accounts from year to year. It allows us to do analysis of our financial statement. Unfortunately, there has been a lot of fraud in the financial market, in the accounting world, in the last 20 years or so. I'm sure there's always been a lot of fraud, but these are major companies with major problems. Our financial statements need to be accurate, timely, and usable. The companies on your screen at this point are companies that did not follow those rules. They did not follow the principles of accounting, and in fact, with intent, provided incorrect, inaccurate financial statements to their stakeholders and stockholders. Decisions, financial decisions were made based upon those fraudulent documents, and millions were lost when these things came to light. Read down through that list. I'm sure you will recognize many of the company names and look at what happened. Ethical conduct. Many companies have employee handbooks and ethical guidelines. Oops, sorry. It is easy to look at companies and say, oh, they're not following their own standards. So we have to make decisions about our own conduct and about the conduct of those we manage. My personal opinion is the ethical conduct of the employees and management of the company will only be as good as the leaders, the top people of the company, the CEO, the CFO, the board of directors. We will follow their lead. Sometimes, even if our personal standards are better than that. It's so easy to get lulled into things when it seems to be a company's culture. You can use your own standards to identify situations that may be unethical. you can determine what its consequences might be on yourself and on others. Then you have to make the decision. Do you have an obligation to report that? Do you just quietly let it happen and hope no one notices? It's a difficult situation because we all have our own set of standards of honesty and fairness. The basics are pretty much the same. Don't lie, don't steal, don't cheat, don't kill anybody. But the nuances of those standards are subject to our own interpretation. So ethical conduct is something we need to monitor within ourselves very carefully. The purpose of doing the bookkeeping work, the accounting work necessary to prepare financial statements is so that they can be used. You will hear me say time and time again, financial statements must be accurate, timely, and usable. If we do not use them, what is the purpose? Why are we going through all of this? Because it can be very time-consuming and tedious. But if we use those financial statements to look at the company's history and then prepare for its future, there's a reason we've prepared the financials. Return on assets, that is a ratio that we will look at. This looks at the company's profitability as it relates to the assets that the company owns. Because all of the assets that the company owns, they own so that they can do the business they're in business to do. They own the plant so that they can produce their product. They own a building so that they can house their employees. They own vehicles so that they can deliver what it is they make. So looking at what type of return they're getting on those assets is very important. Here is the equation. Net income before taxes and interest divided by your average total assets, and we will look at calculating that in chapters to come. And something to note, there is no correct return on assets rate. It depends on the company. If a company doesn't own a whole lot of assets, its return is going to be very high. Take my company, for example. I own an accounting business. My assets are a few desks, some computers, some file cabinets. Not a lot of money involved there. So my rate of return on assets is extremely high. Think of somebody like AK Steel. Look at all that they own, all the plant, all the equipment, all of the things. Their return on assets is going to be much, much lower. So this ratio must always be taken in context with the business that it is related to. Here are some examples. Apple has a return on asset rate of 38.1%. Dell, only 10%. Now those are both computer companies, so they're similar. So it tells you that based on initial review, Apple's return is much, much better. But there are many, many things that must be taken into consideration. The assets that are involved. Are they newly purchased? Have they been there a while? Is one company retooling their factory while another company's factory has been there? All of those things play into what the total assets are, which again plays into the rate of return. So remember, anytime you're looking at a number on a financial statement or a ratio that has been created from those financial statements, the number or ratio itself should only lead us to ask questions. This is the what. We need to know the why. This is the end of Chapter 1. I hope you have enjoyed this lecture, and if you have any questions, please post those on the discussion board for Chapter 1. Thank you.